Earnings per share, EPS, is one of the most widely used measures of corporate profitability and shareholder performance. It represents the portion of a company's earnings attributable to each outstanding common share and serves as an important indicator for investors, analysts, and financial markets. The program explains that EPS helps evaluate profitability, compare companies, and assess trends in earnings growth over time. Because stock prices often react strongly to reported EPS figures, companies closely monitor their ability to meet analyst expectations. EPS also plays a central role in valuation techniques such as the price-to-earnings ratio. Understanding the calculation and interpretation of EPS is therefore essential for effective financial statement analysis and investment decision-making. Basic EPS is calculated by dividing net income available to common shareholders by the weighted average number of common shares outstanding during the reporting period. Preferred dividends are subtracted from net income because preferred shareholders have a prior claim on earnings before common shareholders. The use of weighted average shares ensures that changes in share count during the year are properly reflected. Analysts must understand how stock issuances, repurchases, and stock splits affect share calculations. Basic EPS provides a straightforward measure of profitability attributable to common equity holders. However, it may not fully capture the potential impact of convertible securities, stock options, or warrants that could dilute existing shareholders' ownership interests in the future. Diluted EPS incorporates the potential effect of securities that can be converted into common shares, such as convertible debt, convertible preferred stock, stock options, and warrants. The program explains that companies with potentially dilutive securities must report diluted EPS in addition to basic EPS. A security is considered dilutive if conversion would reduce EPS. The objective of diluted EPS is to provide a more conservative measure of profitability by showing what earnings per share could become if all eligible securities were converted into common stock. Analysts use diluted EPS to assess the potential dilution risk faced by current shareholders and evaluate the company's broader capital structure and financing strategy. The treatment of convertible securities in diluted EPS calculations depends on the type of instrument involved. For convertible preferred shares, analysts add back preferred dividends to net income and increase the share count by the number of shares issued upon conversion. For convertible debt, after-tax interest expense is added back because the debt would no longer exist if converted into equity. Stock options and warrants are generally analyzed using the treasury stock method, which assumes proceeds from exercise are used to repurchase shares at the average market price. These adjustments ensure diluted EPS reflects the maximum realistic reduction in shareholder earnings. Understanding these calculations is critical for interpreting reported profitability and comparing firms consistently. EPS analysis also has important implications for financial reporting quality and earnings management. Because investors and markets closely monitor EPS performance, management may face pressure to meet or exceed analyst expectations. This incentive can encourage aggressive accounting practices, share repurchases timed to improve EPS, or short-term financial decisions that prioritize reported earnings over long-term value creation. Analysts should therefore evaluate not only the numerical EPS result but also the quality and sustainability of underlying earnings. Comparing basic and diluted EPS, reviewing footnote disclosures, and analyzing trends in share issuance or buybacks can provide valuable insight into management strategy, capital structure decisions, and the reliability of reported financial performance. While EPS is a useful performance measure, analysts must recognize its limitations. EPS does not directly measure cash flow generation, operational efficiency, or economic value creation. Companies with identical EPS may have very different risk profiles, capital structures, or growth prospects. Additionally, accounting choices, non-recurring items, and changes in share count can significantly influence reported EPS without reflecting genuine improvements in business performance. Therefore, EPS should be analyzed together with other financial metrics such as cash flow, return on equity, profit margins, and leverage ratios. A comprehensive understanding of EPS enables analysts to interpret profitability more accurately, assess shareholder value, and make more informed investment and valuation decisions in global capital markets.